Hi folks, I'm Mike Larson with Money and Markets TV. Is it just me, or does it seem like we've been here before? Oil prices are soaring into the triple digits, driving the cost of gas toward $4 a gallon and beyond. Soybeans are skyrocketing, wheat is surging, corn is flying, copper, aluminum, platinum, gold, silver are all going ballistic. And as you can see from today's steep decline against the Japanese yen, the dollar is plunging against developed world currencies and emerging market currencies alike. So what about the Federal Reserve? What's it doing in response? It's explaining it all away, washing its hands of responsibility, pointing to useless, outdated inflation measures to avoid actually doing anything about the exploding cost of living. Now, if you have the same sense of deja vu that I do, it's because we've been here before. Back in 2007 and 2008, crude oil prices almost tripled from $50 to $147 a barrel. Gold rocketed from around $650 an ounce to over $1,000. Copper surged to $4.27 a pound, while corn more than doubled to $7.76 a bushel. Now, I'll be the first to admit that some of those gains stemmed from fundamental market forces: tight supply, rising demand, and weather conditions in certain producing regions. You get the picture. But a huge key culprit back then, just like now, was the Fed, plain and simple. The Fed enabled rampant speculation by keeping interest rates incredibly low. Policymakers also said that food and energy inflation would be ignored, essentially telling Wall Street, go ahead, take this easy money we're printing and buy all these commodities. In fact, in November 2007, former Fed Governor Randall Kroszner said, quote, "Sizable increases in energy and food prices have contributed to a pickup in headline inflation this year, but the developments on core inflation, which excludes prices for food and energy items, have been moving in a more favorable direction," end quote. So what's the Fed doing now? Did it learn from that painful lesson when surging prices first drove inflation through the roof, then helped contribute to the nastiest recession in decades? No. It's trotting out the same tired arguments and making the same policy mistakes again. Case in point, Chicago Fed President Charles Evans claimed in a CNBC interview this week that the Fed has nothing to do with the current surge in commodity prices. And Peter Diamond, who's currently on his way to being confirmed for a seat on the Fed's Board of Governors, said that he views commodity prices as driven by micro factors, not general stimulation of the economy. So while the rest of the world's raising interest rates to combat inflation, our central bank is dragging its feet. It's keeping the liquidity spigots open, once again helping enable speculators with all the easy money they need. Folks, that means you can expect gold and silver prices to continue rising. You can expect the dollar to generally fall against fundamentally strong currencies. You can expect interest rates to climb. And even if some of the Libya premium comes out of oil in the short term, say if domestic rebels, NATO, or the Arab League figure out a way to send Muammar Gaddafi packing, you can expect energy prices to keep climbing. My suggestions? Number 1, keep riding the Fed's easy money wave as long as it lasts. 2, buy select resource stocks and investments. 3, hedge against rising interest rates using inverse bond ETFs. 4, don't listen to the ridiculous pablum being spewed by Fed officials. Rising commodities prices are inflationary, and they are most definitely the Fed's fault. No ifs, ands, or buts about it. Finally, consider giving my Safe Money Report a try. It offers indispensable help in these treacherous times with a rock-solid guarantee. I'm Mike Larson for Money and Markets TV. Thanks for watching.